Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at REalloys.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really get into it, you can check out the StockOracle special 14-day trial link below in the description.
Yeah, and just so you know, StockOracle is an AI-aided stock research platform. It's not financial advice, it's not a trading signal service, and it doesn't provide real-time market data.
Exactly. And we have to mention that the link down there is an affiliate link, so the channel may earn a commission at no extra cost to you.
Right, which helps us out. But do keep in mind that StockOracle's AI insights and valuation estimates, well, they can be incomplete or sometimes wrong, so you always want to verify important facts yourself.
Always. Okay, so let's get into REalloys, ticker symbol ALOY. Imagine a $12 billion pile of government cash just sitting on a table, right? And it's guarded by a ticking clock set for 2027.
A very loud ticking clock.
Yeah, exactly. And on the other side of the room, you have a startup burning through $100 million a quarter, desperately trying to build a bridge to reach that cash before they go completely bankrupt.
It's intense.
It really is. That is the exact scenario playing out right now in our analysis today.
Yeah.
We're trying to figure out how to weigh this undeniably massive macro narrative against some absolutely brutal financial realities for REalloys.
Yeah, it's like the ultimate stress test of, theory versus practice in the modern markets. On paper, the narrative makes perfect strategic sense.
Right.
I mean, the global supply chain for critical rare earth materials is overwhelmingly dominated by China. So REalloys is attempting to build a U.S.-aligned supply chain totally from scratch.
Which is a huge undertaking.
Oh, massive. But when you look past the geopolitical headlines, the actual balance sheet tells a much riskier story about, well, the cost of that ambition.
Okay, so let's unpack the wealth-building context here, starting with what we might call the geopolitical fortress. This is the bull narrative. REalloys is positioning itself as this mine-to-magnet supply chain.
Yeah.
And the macro tailwinds pushing them are historic. I mean, we have the August 2026 announcement from President Trump about Project Vault.
Right, the $12 billion strategic critical mineral stockpile.
Exactly. And looking at that purely as a market catalyst, a $12 billion injection is a blindingly bright demand signal for the whole sector.
It completely alters the risk profile. You know? When a government announces a reserve that big, it's essentially trying to create an artificial price floor.
Yeah.
It tells institutional capital that domestic rare earth production isn't just some speculative industrial idea anymore. It's a funded national security priority.
But the demand signal is only half the equation.
Exactly. The other half is the enforcement mechanism.
Well, we're talking about the 2027 statutory deadline.
Yes. So under current defense regulations, the Pentagon faces this hard statutory deadline in 2027 that prohibits them from sourcing materials from restricted entities.
Meaning China.
Right. It means the U.S. defense apparatus is legally barred from buying high-strength magnets or rare earth components that trace back to the Chinese supply chain.
Hold on, I got to push back on that a bit. I mean, a $12 billion stockpile and a sourcing ban, those are massive catalysts for the sector as a whole, sure.
Definitely.
But does that actually guarantee REalloys sees a single dime of it? Like, if their facilities aren't built by 2027, the government is just going to buy from an allied nation like Australia or Canada.
Oh, that's a very real possibility.
It sounds like they're trying to build a toll bridge that the government mandated everyone has to use, but they don't actually have a monopoly on the river yet.
And that right there is the fatal flaw in the pure macro thesis. It's exactly why REalloys is scrambling to lock down exclusive partnerships.
Right. They're trying to build a moat.
Yeah, they aren't trying to do it entirely alone. They just secured an exclusive supply agreement with the Saskatchewan Research Council, or SRC.
Oh, yeah, the SRC deal.
Yeah, so ALOY committed $20.6 million toward facility upgrades up there. Yeah. And in exchange, they get up to 80% of the expanded output.
Which is a brilliant way to offshore the actual mining risk. But looking at the fundamentals, I was really struck by the chemistry involved in what SRC is actually doing.
Oh, it's wild.
We throw around terms like rare earth processing, but separating these elements, specifically neodymium praseodymium, or NdPr, that is a monumental chemical engineering hurdle.
It's arguably one of the most complex metallurgical processes on Earth. I mean, extracting NdPr isn't like mining copper.
Right, you don't just dig it out of the ground.
Exactly. The lanthanide series elements are chemically almost identical to one another, so taking them apart requires this continuous solvent extraction.
Like running highly toxic acids through machines.
Yeah, acidic slurries going through hundreds of sequential mixer settlers. You're relying on.
Wow. So when REalloys says they're targeting production of 525 tons of NdPr and 30 tons of dysprosium at that SRC facility by the fourth quarter of 2027.
That's not just a financial target.
No, that is a ticking time bomb of chemical engineering. If a single stage of that solvent extraction process fails to scale, their whole timeline collapses.
And if we connect this back to the valuation, that technical risk is what the market might be mispricing right now.
Yeah.
I mean, ALOY also landed a Defense Logistics Agency contract for domestic samarium production, and they signed a non-binding letter of intent for a North American magnet platform with a group called JS Link.
Which sounds great on paper.
It paints a beautiful picture, right?
Yeah.
Raw material, defense contracts, final magnet production. But the moat is entirely prospective. These are pre-commercial, highly technical arrangements being negotiated against an unforgiving statutory clock.
Which brings us crashing right into the fundamentals. Because mastering solvent extraction and building a geopolitical fortress, well, that's a capital bonfire.
Oh, completely.
I experienced genuine shock looking at the valuation disconnect here. If you're looking at your screen right now, REalloys has a market capitalization of roughly $844 million.
Right.
But their implied annual revenue is only about $2.5 million.
The multiples are staggering. I mean, a price-to-sales ratio of over 330. That means the market is pricing in decades of flawless, scaled execution.
It's great.
Investors are paying $330 today for every single dollar of revenue the company currently generates.
And it's worse than just low revenue, right? It's the velocity of the cash burn. I mean, they posted a first quarter loss of $106.7 million.
Yeah.
With a net margin of negative 4,325%. How do you even sustain operations when the cash is vaporizing that quickly?
Well, you survive by going to the capital markets and just taking whatever terms they force on you.
Right.
In their SEC filings, ALOY actually faced a going concern doubt as recently as their September 2025 interim financials.
Which is terrifying for an investor.
Truly, management cleared that hurdle, but the mechanism they used to survive was a brutal dilution cycle. They had to raise $150 million across 2 equity offerings in a span of just 4 months in 2026.
And the structure of those raises, that's what really caught my eye when looking at the risks.
Yeah, the pricing step down.
Exactly. They raised $46.8 million in March at $18.50 a share. Then, just a few months later in June, when they needed that massive $100 million lifeline, the private placement was priced at $14.25.
That aggressive step down is the classic hallmark of a distressed capital raise. I mean, diluting at a heavily discounted price point isn't just raising money, it drastically alters the cap table.
Like selling off the furniture to pay the mortgage.
Or think of it like hosting a pizza party where new guests keep arriving, but instead of ordering more pizzas, you just keep slicing the existing pizza into thinner and thinner pieces.
I love that analogy.
By the time those institutional investors showed up in June demanding a steep discount, the early retail investors were basically left holding paper-thin slices of the company's future upside.
And with a $100 million quarterly burn rate, the math dictates that those June investors won't be the last guests arriving at the party.
Definitely not.
If they don't have commercial cash flow by early next year, they're going to have to go back to the well, and it's likely going to be at an even lower valuation.
Which creates a vicious cycle. Every new share issued at a lower price permanently impairs the value of the existing shares. And it raises the cost of capital for the next raise.
It's a death spiral.
But despite all of this, despite the cash burn, the heavy dilution, the negative margins, we are seeing an incredibly counterintuitive technical setup in the stock right now.
Yeah, let's look at that paradox in the technicals.
Yeah.
Over a 5-day period recently, the stock spiked almost 25%, closing at $12.27. And the trading volume was 1.5 times their historical average, with a beta of 1.43. Why on earth is retail momentum rushing into a stock that just had to drastically dilute its shareholders just to keep the lights on?
Because the market is treating ALO as a proxy for the entire macro thesis. This is purely trading the news versus trading the fundamentals.
Ah, right.
When Project Vault was announced, traders didn't pull up ALOY's balance sheet to check their net margins. They saw a US-based rare earth ticker with high beta, and they just piled in.
Buying the hype?
Exactly. They're buying the headline, assuming that a $12 billion rising tide will inevitably lift this specific boat.
But the sentiment among the smart money is completely fractured on whether that boat is actually seaworthy.
It really is.
The analyst targets show a massive divergence. Clear Street is maintaining this wildly bullish $35 price target, but Needham just lowered their target from $19 down to $16.
Yeah, that is a $19 delta between two professional desks looking at the exact same data.
Huge.
And that delta represents the probability weighting of hitting that Q4 2027 deadline. Clear Street is valuing the company based on a successful transition to a commercial monopoly.
And Needham
is aggressively discounting the target because they're pricing in the execution risk of those complex chemical facilities, plus the likelihood of further dilution.
And if you're looking for a tiebreaker between those two outlooks, usually look at the insiders, right? Like, are the executives buying their own stock at $12 if they truly believe it's going to $35?
Yeah, right. And what's fascinating here is the utter lack of insider conviction. The data specifically flags that there have been 0 open market insider buys recently. Zero.
So retail is bidding the stock up 25%, but the people who actually know the true state of the solvent extraction facilities aren't putting a single dime of their own money on a line.
None. Now, the necessary context here is that the officers and directors are under a lockup agreement from that June capital raise.
Okay, fair.
But even acknowledging the lockup, the absence of insider accumulation removes a critical psychological floor for the stock.
Makes sense.
The current valuation is floating entirely on retail sentiment and speculative momentum. There is no fundamental earnings floor, and there is no insider buying floor.
It's just a sentiment tug of war happening on the edge of a cliff.
I get.
I mean, the stock is still down over 54% from its 52-week high of nearly $27.
Right.
So the existential bear case question for REalloys is, how do they bridge the gap? How do you transition from a cash-burning startup surviving on discounted private placements to an actual revenue-generating pillar of national security?
Well, the path forward is very clear, but it's narrow. They have to convert non-binding promises into binding commercial contracts.
Right.
A massive portion of their speculative value is currently locked up in letters of intent, specifically that JS Link magnet platform and a strategic alliance with the Sheep Creek deposit.
But a letter of intent, I mean, that's essentially just an agreement to explore an agreement.
Yeah.
You can't finance a billion-dollar supply chain with an LOI. They can walk away at any time.
You really can't. REalloys has a roughly 15-month window, funded by that recent $100 million raise, to turn those LOIs into off-take agreements.
And those need to specify exactly what?
Exact volumes, exact delivery dates, and exact pricing.
Right.
Without binding contracts, they cannot secure the non-dilutive debt financing they need to actually finish building these facilities.
Which brings us back to the real insight here. The core issue isn't just that REalloys is burning cash.
Right.
It's that the U.S. government is attempting to compress what should be a 20-year industrial evolution into a 3-year statutory window.
That's a great way to put it.
When you force a timeline like that, demanding domestic NdPr separation by 2027, you mathematically guarantee catastrophic cash burn rates for the early movers. REalloys is essentially paying the first mover penalty to establish U.S. national security.
That is exactly what's happening. The capital required to compress that timeline is astronomical, and the early shareholders are the ones subsidizing it. The ultimate focal point for that timeline remains the SRC facility. The capacity targets of 525 tons of NdPr and 30 tons of dysprosium by Q4 2027. Those are the binary event for this company.
So if you're a listener looking at your portfolio right now, trying to decide if this momentum is real or just a retail trap, what are the actual fundamental signals that they're successfully paying that first mover penalty and coming out the other side?
You really have to look for two distinct milestones.
Yeah.
On the fundamental side, we need to see sequential quarterly revenue actually bridge into the $5 to $10 million range.
Right, actual money coming in.
Exactly. That proves they have moved from development stage capital incineration to actual commercial plumbing that works.
And structurally, what are we looking for in the price action?
Watch that $16 price target set by Needham. That $16 level is a massive psychological and technical threshold.
Yep.
If the stock can reclaim $16 and hold it against the short sellers, it signals that institutional capital, not just retail day traders, is starting to price in a higher probability of them actually executing on the 2027 mandates.
Okay, so bringing it all together for the final verdict, based on all the metrics we've discussed today, the overall investment rating for REalloys is a 4, which equates to a bullish score that's effectively neutral with a heavy, cautious tilt.
Yeah, that perfectly aligns with the data.
And looking at the long-term view, remember, this is not us telling you to buy, sell, or hold. We're just outlining that this is a highly speculative binary bet.
Absolutely binary.
The upside is securing a government-linked defensible monopoly over materials the defense and tech sectors literally cannot function without.
And the downside.
The downside is the technology fails to scale, the cash runs out, the share structure collapses under the weight of dilution, and the equity basically goes to zero.
It really is a perfect masterclass in separating macroeconomic inevitability from microeconomic survival. Just because the United States desperately needs a domestic rare earth supply chain to exist does not mean the specific company trying to build it is a safe place to park your capital.
Yeah.
A pristine macro narrative cannot shield you from a toxic balance sheet.
Such a good point.
Hmm.
Which leaves us with a critical tension to think about, not just for the rare earth sector, but for the broader economy as a whole as we enter this era of aggressive industrial policy.
Right. It raises a deeply uncomfortable question.
Which is?
When a government attempts to force a supply chain into existence through mandates and $12 billion stockpiles, does it actually eliminate the risk of failure for the startups involved, or does it just change who ends up paying the bill when the concrete never gets poured?
A heavy question for you to mull over, but that is the reality of navigating the geopolitical fault lines of the market today. If you enjoyed this breakdown, don't forget to subscribe and definitely check out that special 14-day trial link for StockOracle in the description below to do your own research on these setups.
See you next time.